Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A, and the first question is from AJ. Very quick sort of summary. AJ's 37, his wife's 40, he earns 200, wife earns 240. They've got about 460 in super, relatively even split between themselves. They've got about total shares combined 300,000, some employee shares, and they've got four properties, a home and three investment properties, all in Brisbane. They have one property. Actually, I'll just talk about each of the first property, investment property, that is, they bought in 16. So good timing there. And then they rebuilt the property, the house, and also has a granny flat. So current value is 1.5. And they're getting $1,500 per week. So let's assume that property is a good quality asset, as in it's got more than 50% land value, and let's say it's in a good location. It is a really good example of, I'm not going to say everyone should do this or it's always going to work. It works now because the timing was perfect. They bought in 16. Brisbane didn't really start kicking off until 18. And it's had a really strong growth cycle since then. So that's why this strategy has worked. But I think it does sort of show that even if you buy a high land value property, whilst you might not do it immediately, in time, what you can do is really improve the cash flow of a high land value property. So because you're buying something that's mostly land value doesn't necessarily mean you've got to live with an asset that's not going to throw off a lot of cash flow for the rest of its life. But if you can do it, if you can buy a high land value property just before a growth cycle and then subsequently improve the asset as well, you've got the best of both worlds really, because you've got a high growth asset that also has good income. Anyway, I just wanted to mention that because the timing's been perfect there for AJ. The next one was purchased in 18. So again, perfect timing there. So purchased for $615 and it's now worth 1.3. So we can see how, timing the market perfectly is a great idea. And then the third investment property has the opportunity to subdivide. And this is the basis of AJ's questions. And so they can subdivide and sell the land, and they could probably get $800 to $850 per block, and they'd make about $400,000 profit. Or if they built the two houses on each block, they could sell for 1.6 each, and they'd make about $500,000 profit. And then, of course, they could build one, keep one, sell one, and asking about setting up a company or trust and transferring the blocks in and so forth. So let's talk about his questions. Firstly, he's asked, which one would I pursue? And this is a really common situation, I should say, that quite often you are much better off in these circumstances to go and buy the property, get the DA, the development approval, to actually, firstly subdivide and then get the DA to build two dwellings on that block, one dwelling on each block, of course, and then sell it. As you can see that AJ's done his calculations. If he doesn't take on the construction risk and cost and time and so forth, he's going to make a $400,000 profit. But if he goes through with the construction, he's going to make a $500,000 profit. So you're going to make an extra $100,000 for taking on the most risky part of this project. And if you're not a builder yourself, or you don't have, some sort of way of mitigating that risk, if you're a builder yourself, you might take it on because your profit's probably going to be higher than an extra 100,000. But if I was faced with that, I'd definitely go and sell without doing the building. It's just not worth the risk just to make an extra $100,000. Now I know an extra 100. I'm not being flagrant. It's a lot of money. What I'm saying is there's things that can go wrong that actually evaporate, so that $100,000 extra profit might not actually be there. So, and that's typically the case, right, in the situations that I've come across where clients are probably better off just getting the DA and then selling it to someone that does a lot of these small scale developments, whether they're builders or whether they've got the experience in doing it. It's a very attractive proposition for someone in that space because they can start building straight away. They don't have the risk of finding counsel on the DA. They don't have the cost associated with it, and they don't have the potential delays associated with it. So it's an attractive proposition for a developer to come along and do it. And it's an unattractive proposition for most passive investors to, take on that additional risk, time, and complexity, just for 25% more profit. If you can make 400 grand off something, it's a pretty good start. AJ's second question is if he plans to repeat this process again, what sort of structure would he use? You probably could use a trust with a corporate beneficiary or maybe just a company. AJ's highlighted that, if the ATO perceives this as trading stock, so that it's a business, you're not going to get the 50% CGT discount. So that doesn't matter. So therefore, a company is kind of good because, well, firstly, you're kind of quarantining risk. Secondly, you're capping your tax rate at 30%, noting that AJ and his wife are both in the top marginal tax rate. And so you're at least capping the tax rate at 30%, and then you can kind of roll that profit into the next opportunity or invest it in something else. Whereas a trust might be okay because it gives you the flexibility not to necessarily distribute into a company, corporate beneficiary. But really, if that's the most likely outcome, looks like it in your situation, AJ, then the trust probably just overcomplicates it. Just do it inside a company. But those shares in the company could be owned by a family trust. So that probably makes sense. That way you still have flexibility by paying out a dividend out of that company and flexibility of where you want to do it, but you don't have to pay out the dividend. Third question is, for the shares, should I consider having a trust? So, okay, the first thing I think about is how much are the shares worth? 300,000. Their wife is 40 and AJ's 37. So still, got maybe 20 years of wealth accumulation journey left. I would lean to putting him in a trust. And that's what I do actually, is because if I get employee shares, depending on the structure, I typically pay tax on those shares. So the cost base is what the shares are worth when they vest. We typically then at that time transfer them into the trust because there's not going to be any CGT. In fact, if the share price has a little bit of volatility, you've got 30 days to transfer them and crystallize a new cost base as well. So that's useful. So you can get the employee shares into the trust. If you're going to make additional share investments, probably makes it worthwhile putting it in the trust. And then, as you said, if you're going to do these subdivisions, you could have a company, and the shares in that company are also owned by the family trust. That seems like to me to be probably the best structure, AJ. But you've got to talk to your registered tax agent. And I've said many times, take advice from someone who has to live with the consequences. So that's what I'd be thinking about, or at least contemplating in your situation. And the last of AJ's questions is, since he's going to be spending time on managing these subdivisions and potential builds, is there a way that he can charge for his time? Well, you could pay yourself a market level salary for that, or remuneration, I should say, but it's not going to be worthwhile because you're both earning over 190. So I think if you're going to do it inside a company where you're paying 30% tax, you probably want to shift as much of the profit into that company as possible. So yes, you could. And, where, for example, we had one spouse that had no income, managing an asset for a spouse that had a very high income, you could pay a market level salary. It needs to be defensible and you need to have the records to demonstrate, that I spent 10 hours on this and whatever it is, and that's what I'm charging. But in your situation, AJ, where you and your spouse are on the highest marginal tax rate, keeping that profit in the company is probably the best way to go. And so not charging for that work is probably the best thing to do. Anyway, thanks for the question, AJ, and thanks for the lovely feedback that you provided as well. I hope that answer's been useful. Okay, next question is from Alejandro, and Alejandro writes, their family income is 120 plus 250, so good incomes. They've got two good quality investment properties valued at $1 million and 1.2 each, and a home valued at $1 million with 150,000 in offset cash. I don't know about the debt and so forth, but the question is that the home isn't performing that well, I'd imagine, from a capital growth rate perspective. So he's asking about, whether he should sell the home and buy another investment property and rentvest. So go and rent somewhere else. And I guess there's two things that come to my mind immediately, and there could be a lot more, of course, once you sort of delve into the planning process. But the first two that come to my mind is when we are faced with a situation of someone that wants to rent vest, I always think about what happens if you change your mind. And the reason and I've said this before in the podcast, the reason I say that is that quite often in my experience, people do end up changing their mind and want to live in their home at some point. And so if I haven't provided for that potential in in a strategy, what I couldn't end up doing is destroying a lot of wealth, because then I've got to kind of take a bit of a U-turn and maybe sell some assets when I don't necessarily want to sell those assets. So the thing that you want to think about then is, if you do this strategy, if you implement this strategy of rent vesting, how are you going to get back into the market and obviously occupy one of your investment properties? And if they're in locations and the type of property that you'd love to live in, then that's fine. But if it's no, buy somewhere else, then you're going to have to sell an asset. And you got to then contemplate, do you want to buy an asset today and potentially have to sell an asset in 5, 10, 15 years' time? Does that make a lot of sense? So that's the first thing that I would think about. And then the second consideration would be, who cares? Now, I know I'm contradicting myself, because I've always spoken about, try and buy a home with an investment lens. And, if your home is otherwise investment grade, but then you occupy it, you get the capital gains tax-free benefit of enjoying that capital growth. So I've said all those things before. But in this situation, Alejandro, if you've got a good income, I don't know what your super looks like, but you've got 2 good quality investment properties, and let's say you're making decent super contributions and you're going to be able to accumulate cash flow over time, that might be enough. Like, it might not be the end of the world that your home isn't generating, good capital growth. I mean, assuming you like living in it and it's, it's in a location and a standard that you're quite happy with, that's okay. It doesn't need to be perfect. Like, in a perfect world, like, if you could make it a great asset, yes, of course, that's going to be better. But, generating more wealth doesn't necessarily change the outcome. Like, if someone says to me, look, give me $200,000 a year and I couldn't imagine spending any more, like, I don't need any more money than that, then why would I change the strategy? If my strategy is already going to deliver that well and truly with a high level of confidence, then arguably, if it ain't broke, don't fix it. So Alejandro, that's the way I would kind of approach this question, or at least think about this question. But I don't have all your details, and I'm not doing a full plan, of course. So there could be more considerations, but they're the two that sort of jump out at me. Hope that helps. Okay, next question is from Luke, and I can see by his email signature, he's a mortgage broker. And Luke's given me some fantastic feedback on the podcast, and also said that, the information he's learned in the podcast has helped him with his discussions with clients as well. Even though he can't give advice, he can at least throw out some ideas. And I wrote a thing probably nearly 15 years ago, this sort of thesis that I thought mortgage brokers were really in a fantastic position to really help people, because a mortgage broker is typically the first financial professional you meet, and that they're kind of a bit of a gatekeeper, because they see, or they get to meet clients before they make a mistake, like, I'm going to buy this asset, I'm going to do this, I'm going to do that. And you can at least say, oh, do you really think that's a good idea? Or go speak to this person and build your network around, build a network around you that can help your clients. And so good on you, Luke, and any other mortgage brokers that listen to this podcast. I think it's an amazing position to be in. You can really help clients. Of course, there's some dodgy mortgage brokers out there as well that, might be referring them to developers for kickbacks and all these sorts of nonsense. You're always going to get that in an industry, but, the top 20% of mortgage brokers are probably adding the most amount of value. And it really is it's a great profession, and you get to help clients a lot. So I'll get off my soapbox now, but I just sort of mentioned that because Luke mentioned that the podcast has helped him with his client conversations. I'm going to summarize Luke's situation. They're mid-30s. They've got 3 younger kids. They've got a family income about $200,000. They've got a home with about $420,000 of debt, and they know they want to upgrade the home in 5 to 10 years. And that upgrade's going to be like $1 million to 1.6. So there's a $600,000 gap there. So we know we need to borrow another $600,000 in 5 to 10 years. That's what it is now, but the gap could widen. And that Luke's done some sums on his super and believes by 60, it'll be worth total combined super about $2 million. So I would imagine that's future dollars. I'm not really sure. But anyway, I think the conclusion there is that Luke knows he needs to do something else in addition to super to get themselves in a financial position that's a bit stronger. And so the challenge that he's faced with is that if he goes and buys an investment grade property, firstly, he doesn't know, he thinks it's a bit challenging from a cash flow perspective. But if he does it, does that then knock out the ability to upgrade the home in the future because you've absorbed all the borrowing capacity within the, used to buy the investment property. And then the flip side is, well, maybe we can gear into shares, but what would you do in our situation? And it's he does mention, it's probably a good question. There's a lot of other people in similar situations thinking the same thing. And it is a good question, Luke. So, thanks for taking the time to give me all that information and submit your question. I guess the first thing is, Luke's kids are 3, and 6 months, right? So they're still really young, and you've got at least 2 kids that aren't in school and maybe one that might be, or at least going to school pretty soon. I mentioned a number of times in the podcast, it's a really difficult period of time to build wealth, right? So in those situations, most people will find they don't have a lot of surplus investable cash flow, and that's fine. Like, don't beat yourself up about it. I think what you need to do is invest as much surplus investable cash flow as you can before you have kids, and then recommence that process when the kids go into school. Normally, when the kids are school age, you kind of expenses come back a little bit because daycare is certainly expensive, and also income tends to rise. So the surplus cash flow position certainly improves. It's just that period of time when you've got young kids that aren't school aged can be really challenging, and it might be just a case of getting through that period of time. So it is difficult, and I acknowledge that. That's why I think there's those windows before you have kids, and certainly don't procrastinate. Start that investment process when they're going to school. What can you do in that situation? What can Luke do? I mean, I think you've got to prioritize some lifestyle outcomes here. So in terms of that home upgrade. So I think that's kind of, to my mind, a non-negotiable. And if you can't do both, then you can't do both. Luke mentioned about debt recycling. So, that is aggressively repaying the home, but then reborrowing against that equity, that new equity that you've created as a result of reducing the home loan, to invest in shares. And by doing that debt recycling, like if I repay 50,000 in my home loan and redraw 50,000 out of an investment loan, separate investment loan, then my total debt profile hasn't changed. So it's a good strategy for people that have tight borrowing capacity in terms of being able, but not necessarily reducing debt per se, but changing the nature of the debt and also still acquiring growth assets. So I think I'd probably do that, Luke. I think, you're still 37, 36. I probably wouldn't be focusing too much more on super contributions. Luke says they already make some additional contributions there. So you don't want to lock too much money away inside super. So whatever you do, I think it'd be outside super. It's obviously not an investment property because of borrowing capacity constraints, and you want to leave that borrowing capacity room for the home upgrade. So the only outcome there is then invest in the share market. And because you're 37, 36, I think you can do that pretty safely at the moment because you've got a long enough runway. Now, how would I do that? Well, look, if I was in your shoes, I think what I would do is go mostly global in terms of global shares, because you're going to get more growth and less income. And then that'll give you some negative gearing benefits as well. So, ultimately, mathematically, the perfect outcome would be $1 of income, just to ensure the interest was tax deductible and all the rest growth. And if you think about, well, do I want to gear today? I think if you're not going to go out and borrow, $1 million and then go and dump it into the market tomorrow. What we're really talking about is, why don't you establish a separate investment loan secured by your home for, let's say, 100,000. Why don't you, if your surplus cash flow is, say, $3,000 a month, what you would do is put $3,000 a month into your home loan as extra repayments, and you would redraw $3,000 from the investment loan, and you would put that into ETFs. So you'd invest $3,000 a month in ETFs. So your gearing in month 1 is 3,000. Your gearing in month 2 is 6,000. So you're gradually kind of easing into the gearing, and that's why that strategy kind of works quite nicely. And so if you then think about, well, do we want to gear into markets when they're at all-time highs, especially obviously US technology has driven a lot of the returns, I would use a value approach. So that would be the best way to kind of mitigate that risk. So at least then you're buying into the market, but you're buying stocks that are trading at attractive prices. So you're still going to get growth, but growth at a reasonable price, not growth at any price. And there's 2 ETFs that you could use, and that I would suggest you use on alternate months. So there's the Vanguard Value one, which is VVLU, and there's a VanEck Value one, which is VLUE. They're the ticker codes. VVLU has a lot of companies in it, so it's very well diversified, but it tends to have very little technology. And that makes sense, right? If we think US tech is overvalued, then of course we wouldn't invest in it and we're going to have lower exposure. So that's good because a lot of diversification, and we're getting a lot of sector diversification as well. So not as much concentration in technology, which now makes up more than 30% of the index, S&P 500 index, of course. And then the Van Eck product, which is VLUE, is a bit different because it's investing, I think, in the top 150 stocks, the most attractively priced 150 stocks, and it has a greater exposure to technology, albeit that technology tends to be based in Europe rather than the US, but we don't really care. It's just a sector exposure, and I think that would play out quite well. So what you would do, using my example, if you had the 3,000 surplus cash flow, put that into your home loan, take 3,000 out of a separate investment loan, make sure these loans are separate, and that investment loan would be interest only, of course. And in month one, invest that 3,000 in VVLU. In month two, invested in VLUE, and then alternate each time. So you're essentially splitting it 50-50, if you like. And the reason we do it like that is, to reduce the trading costs, which aren't going to be much. I mean, you can use beta shares direct, for example, to do that, and you're not going to pay any brokerage fees. So there's a really cost-effective way of doing that. Now, in terms of ownership, in terms of how you would do this gearing strategy, so who's going to own the ETFs? I mean, you need to think about what are your incomes going to be in the future, particularly when the kids are older. So at the moment, the income, as I said, family income was 200. Luke was 140 and his wife was 60. So would that change? Like, would that become more even? Luke's income's likely to increase over time, but it's not guaranteed. So I'd just really think about that. And also you got to think, well, there's going to be some negative gearing benefits because the interest cost is always going to be, greater than the distributions that you're going to get off these ETFs. So then you'd say, well, maybe we should put it in Luke's name for the negative gearing. But then you got to think about the capital gains tax consequences. So if you expected your wife's income to increase in the future, and you expect your incomes to be broadly similar, or at least broadly similar marginal tax rates, I'd probably go joint names. But depending on the quantum, I use the $3,000 as an example for the strategy. But if you're investing larger amounts, you might even think about a trust, something you can talk to your accountant about perhaps. But Luke, I hope that's been useful in terms of commentary, and I hope that's useful to everyone else that might be similar to Luke's position. And thank you so much, Luke, for writing in and sharing your fantastic feedback. Okay, next question. I'll read it out. Thank you for selflessly producing a high quality personal finance content, which is easily the best in Australia. Thanks so much. I appreciate that. Also, it's been a while since you've done a case study episode, which were great and inspiring. I hope to see those in the future. Yeah, I used to do the talk about client case studies. Look, I hope to do it in the future. I've got so many emails and questions, which I find quite interesting, and then do bring up these sort of micro topics that aren't big enough to deal with in a or dedicate a whole episode to, but are still worth mentioning. But I am keen to do some case studies in the future. Maybe we can really think about that, whether we can weave them in. Okay, in terms of rundown, they're both 35 twin boys that are 3 years old. One earns 240, the other 150. Good with financial discipline. High daycare expenses. Just spoke about how costly it is when you've got a younger family. 450,000 in super. They've got a home that's mostly building value, that's worth about 1.9 with about 800 of home loan debt. They've got a $200,000 investment loan against that equity, which they use to buy IVV and A200, which ironically, that's S&P 500 and ASX 200. The ASX is underperformed relative to the global market, and the S&P 500 also hasn't done that well in 2025 relative to the global index, and has quite a lot of concentration risk. So you got $200,000 of the debt against that portfolio that's now worth about 300. This is the challenge. What do you do with that? I'd actually rather invest in VEU, for example, which would be all global, excluding the US. Feels a bit safer to me, would have produced a much better return this year. But then you got the problem with the trading costs and the CGT. So anyway, I'm not going to offer a solution to that. I'm just here to point out, I'm here to create problems, not solutions. But that's the problem with having, I don't know how you built this portfolio, whether you just borrowed 200 and just dumped it in the market, but this is the benefit, I think, of regular investing and even with regular gearing. And this kind of links into the previous question. That's why I kind of like these Q&As. But what you want to do is try and build a portfolio over time. And the best way to address concentration risk is to invest more. So, I might have been investing in IVV maybe 5 years ago, but I probably would have stopped 5 years ago. Probably wouldn't be investing in A200, particularly given CBA has been a bit of a drag there. So, if we're going to then you use different indexing methodologies. So maybe you would have used QOZ, for example, fundamental indexing in Australia to accommodate the CBA issue. But regular investing, I would be maybe using some of those value ETFs that I just spoke about, or VU, for instance, to dilute the IVV exposure. But when you put such large amounts into only a handful of ETFs, you have to then think about how am I going to deal with the issue if I've used all my capital already? How am I going to deal with the issue if I start to become uncomfortable with the concentration risk? And so to avoid selling, the best thing then to do is to divert future investment. And that's why I think building a portfolio over time, investing regularly is better than just making lump sum investments, because you kind of can deal with that risk. Anyway, move on, Stuart. Okay, they've got a investment property worth about $500,000 in Quakers Hill. They're in New South Wales in Sydney, with about 1.2 mil of debt. And they make some comments and questions. Happy with their super. Think their investment properties are okay. They'd like to invest another 250, 300,000 in ETFs. Well, okay, that's good news. Well, you might be able to dilute, what you've got. I mean, it's a bit of money there. Maybe you should get some advice in terms of portfolio construction. Number 3, they understand that their primary place of residence isn't high quality, and their goal is to move to a better suburb. So that is houses with larger land around them, and that'll cost about $2.5 million in today's dollars. So that's an extra $500,000 or something in terms of additional cost, maybe a little bit more. And they would like for the wife to retire or semi-retire in 10 years. So what's the best way forward? Well, I guess you've got 3-year-old twin boys. I've been there, done that. And, the same comments apply to the previous question, where it's difficult because you've got, daycare expenses. They've said they're spending $5,000 a month. That's $60,000. That's an investment strategy in itself. Do you mean if you could invest $60,000 a year, you can do a lot with that money? So I think I won't repeat the same comments, but I just point to those comments that it's difficult time to make some decisions, and you've got to acknowledge that in a few years' time, your cash flow situation is going to be different. So don't commit to a strategy today based on what you know. You've got to think about those things, and sometimes you just need a bit of patience. So maybe don't do anything for the next 2 years and then wait for that time to happen. Look, it's similar to the other scenario as well, as in you want to do a home upgrade in the future, and that's going to give rise to more debt, which when the childcare costs disappear will be affordable. If you're happy with the investment property, I mean, that'd be a question. Are you happy with the investment property? If you assume you are, and you've said you are, then really maybe it's a similar strategy in terms of debt recycling, as in gradually monthly investing through borrowings and then putting any surplus cash flow into the home loan. And you could dial that up, to a greater extent when your childcare costs disappear. And that might be a nice way to sort of deal with the concentration risk in terms of, I'm not too worried about A200, but, I'm not over the moon with IVV in terms of the inherent risk within that index. And so maybe that's a way in which you can deal with that risk in terms of just dilute it. So avoid US and avoid anything that's market cap index that's going to give you that greater exposure to the US. Apart from that, I'm not really sure. I mean, if you really are happy with the investment property in Sydney, and then your super is well invested, then it's really just about building out that equity portfolio, I would think, and see how you go for the next few years, and then probably revisiting when the kids are kind of school age and your cash flow might be a little bit stronger. But thank you for your question. Thank you for everyone that writes in their questions. I really appreciate it. Investopoly.com.au. Questions@investopoly.com.au is the email address. So keep writing in. We're just about to start on questions received in October, and I'm recording this obviously end of December, so you can see there's a little bit of time, but we promise to get through all of them. And what I was going to say, tomorrow is part 2 of the Wealth First Principles series, and I'm going to talk about property investing. So until then, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.